Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Today we are taking up Inox Wind. It's been a fantastic last 12 months for this particular company, not only on the back of the changes that the company has seen in fundamentals, but also in terms of price action. There's certainly been a lot of outperformance. And as usual, let me start by telling you about what this particular company does. It is part of the Inox Group and one of the leading companies, in fact, as far as this particular group is concerned. It does look at the business, it is in the business of manufacturing wind turbine generators. It, in fact, has a manufacturing capacity of around 2.5 gigawatts across 4 facilities. And well, at the moment, it also has a considerably large order book of around 3.3 gigawatts. Yes, if I'm not mistaken, that's what it has. So it does seem like it has plenty in terms of visibility going forward. Now, Inox Wind is a fully integrated company in terms of wind energy. Particularly, it's a maker of wind turbine generators, but it also provides other renewable solutions. And it is essentially also an EPC service provider. Inox Green, of course, is also a provider of operations and maintenance solutions. And Inox Renewables and Inox Green are Inox Wind subsidiaries. So that's just in case there's any confusion as to where Inox Renewables and Inox Green comes through and what role they have to play as far as Inox Wind is concerned. On a consolidated basis, however, Inox Wind is what we are looking at and going to try and figure out this company in this show today. So as usual, what we usually do is we talk about how the company has done over the past few years, and keeping the income statement in mind, the kind of order book that the company currently has. We talk about the balance sheets and the cash flows as well, and how things are panning out there for the particular company. And moving on, we talk about other factors like return ratios, shareholding pattern, how the stock has done, as well as what the street is making of this particular company. So let's start by taking a look at the income statement. And when it comes to the income statement, it's actually done quite well over the past 3 years at least. So it has seen its revenue move from 700 odd crores back in FY22 all the way to nearly 1800 crores in FY24. In fact, as of the first 9 months of FY25, it has already surpassed the kind of revenues it has seen in FY24. So it does seem like it's going to be one of the strongest years that the company has seen. Let's talk about profitability as well. Perhaps we can take out, how things have panned out when it comes to EBITDA. And from a large negative of around 430 crores and 667 odd crores in terms of an operating loss in FY22, FY23, in the 9 months of FY25, the company has already become profitable, and by quite a margin. So there is a considerable amount of change in the company and the prospects for this particular company going in. Now, this is as far as, of course, your EBITDA trends too. Let's move on and talk about your several other margins. Perhaps we can bring out margins as well. So for FY24, your EBITDA margins coming in at around 18%, and the first 9 months, again, your margins coming in at around 23%. It's something that we're going to take up with the management too. But it does seem like, based on all of this, the company is on an ascending trajectory. And it does look like there's a lot of improvement and a lot of metrics, which is why, at least as far as its income statement is concerned, we're going to give the company a thumbs up. Let's move on and talk about its order book position. This is another important one because this actually gives you an idea of the visibility for the company. And as you can see, we are looking at a steady growth in your order book as well for Inox Wind. Back in the second quarter of FY24, that order book stood at around 1.3 gigawatts, a little less than that, eventually going to, 2.5 gigawatts back in the start of FY25, and 9 months down the line, that particular order book currently stands at around 3.3 gigawatts. It's something that we're going to talk to the management about as well. And the order book revenue visibility stands at around 19,700 crores over the next 2 to 3 years. And the company earns an average 6 crores per megawatt. So it is considerable. It's also something that we're going to keep an eye on as well. But overall, in terms of visibility as well, we're going to give it a thumbs up to the company. So that's 2 thumbs up so far. let's talk about the balance sheet then. And this is another interesting one here. What we are seeing is, equity shareholders' funds or values, in general, we're looking at about 323 odd crores. That's the net worth of the company. As far as its borrowing is concerned, that stands at around 403 odd crores. That's its overall gross borrowing. But its cash balance stands at around 361 crores, which actually takes its net debt to a very, very negligible number at the moment. So it's actually favorable for the company. It does seem like the company is sitting on a fairly strong balance sheet position as well. So, well, no issues there either. So it's going to be a thumbs up as far as the balance sheet is concerned too. Do remember, these values are for the first half of FY25, and there has been an improvement in terms of its operating metrics over FY24 as well, which is why it's going to be a thumbs up. Now, let's come to maybe one or two concerns here, and the return ratios. So when it comes to the return on capital employed, as one might expect, because of the fact that the company is coming out of, well, operational losses, naturally the return ratios are going to be in the negative right now. But the positive is that these return ratios, that is, the negativity is reducing. And because of that, we're going to give it a neutral rating. So the return on capital employed ratio is looking at an improvement, even though it is moving into the red. It does seem like it's poised to move into the green at the moment, considering the kind of order flows that the company is seeing and the kind of operational metric that we have seen in terms of its order, or rather income statement as well as the balance sheet. So that's going to be another positive, and hence I'm going to give this one a neutral rating. Moving on to cash flows, again, well, because of the fact this is a capital-intensive, business, we're looking at your overall cash flows from operations turning positive at around 22 odd crores, and net cash flows from operations as well has turned positive in the first half. But because it's just the first half, we'll wait for the financial year to end, and that will give us a better picture of how cash flows have panned out. Well, this is as far as your overall financial statements are concerned, coming down to Inox Wind. The real question is that if you look beyond the financial statements, and they certainly do indicate a lot of improvement over the last few years, where do the other metrics stand? So let's talk about the shareholding pattern. At the moment, we do know that the Inox Group holds about a little over 48% in the company. We have a considerable amount of high institutional holding in the company. So when it comes to DIIs and FIIs, again, DII is holding 9.8%. It's also seen an increase in the DII holding. FII holding, on the other hand, has seen a little bit of a drop, but it still stands at well over 15.2%, 15.3%, close to that. And your public shareholding, well, that largely stands at around 26.7%. So what's really exchanged hands is just between DIIs and FIIs, and I'd reckon that the FII decline is also not necessarily because of the company itself, but because of the overall environment with respect to capital markets in general, not necessarily to do anything with Inox Wind, which is why we'll give this one a thumbs up as well. So pretty steady when it comes to the financial statements, pretty steady when it comes to the shareholding at the moment. Now let's come to the more interesting part here, and that is how the company has done. Now, over the last 6 months, the company has declined around 4%. But Inox Wind has outperformed the chunk of the broader market indices. So the Nifty Mid-Cap Index or the Nifty Small-Cap Index, hasn't done as well. In fact, in the last 1 year, it has moved up around 35%, and this is about, well, if I'm not mistaken, about 4 to 5 times better than what we've seen as far as the mid-cap index is concerned. So it's going to be a thumbs up overall. There's been a significant amount of outperformance here as far as the company is concerned in terms of the returns that it has given, rather the returns the stock price has given to the shareholders. So it's going to be another thumbs up. Just want to point out, over the last 5 years, it's moved up 17 times. So it's a clear multi-bagger. There's no doubt about that as well. And perhaps over the last 5 years, there's been yet another staggering outperformance as far as the particular company is concerned. Moving down to street coverage, what is the street making of this particular aspect? What is this particular company? So we don't have a lot of analysts. We have about 6 analysts on the street who cover Inox Wind. and it does seem like that they are bullish as far as Inox Wind is concerned. So firstly, we have 5 out of 6 buys on this particular company, just 1 hold and no sells on this particular company. And in fact, the consensus target at the moment, as far as this list of analysts is concerned, indicates an upside of around 40% from current market levels. So it does seem like at least analysts are looking favorably at Inox Wind at this point in time, especially given the market conditions right there. So it's going to be a thumbs up here as well. So if you consider all the factors that we've spoken about with respect to where the company is, and I'm not going to talk too much about the valuations, because if we consider just the price to earnings valuation, it may not necessarily be a fair picture, because like I mentioned, that the company's come out of losses very, very recently, and naturally the price to earnings ratio is going to be considerably large, which is why we thought that it would be a better idea to perhaps judge the company on several other parameters. And hence, when you come down to all these other parameters, let's take a look at how things are shaping up. So income statement, order book, balance sheet, all thumbs up. It's a neutral for cash flows. Moving on, again, a thumbs up for perhaps the shareholding pattern. And certainly a very strong one in terms of what the company has done, or rather what the price of the share has done over the past few years along with street coverage, which is also a thumbs up. And that brings us a total score for the company at around 6.5 out of 8. So certainly on a very, very strong footing. Want to end this particular segment of the show by talking about the management commentary in terms of guidance, and perhaps we can get a better picture, an updated picture from the management. The full year margins are expected to be at around 17%, and they are looking at targeting an execution of around maybe 800 megawatts in FY25 and about another 1,200 megawatts in FY26. But we'll get more clarifications on this particular aspect. I'm going to get in the management of the company as well, but for this particular conversation, I'm also joined by my colleague Neeraj Shah, who's going to perhaps help us put more light, shed more light on the particular company. Neeraj, thanks for joining in.
I'm glad to be here, Agam. Yeah. I don't know how much more I can add after all the fabulous explaining that you've done already on this one.
Well, thanks, man.
But I mean, the one thing that you said, Agam, is very true, that for this sector at large, Inox, Wind, Suzlon, etc., the past is not an indication of what the future will be, because the sector has come out of the losses. So I think that's a very important factor to consider.
Right.
And maybe 4 years, 5 years out, we can look at the past and then try and ask whether they can actually do an encore of what they've done in the last 5 years over the next 5. But maybe that is something that is reserved for the future, I would reckon.
Right, absolutely. So, on that note, let's get in Devansh Jain. He's the Executive Director at Inox GFL Group, who joins us on the show. Devansh, good morning. Thanks for joining in. Devansh, first and foremost, I'm going to take a view on the entire sector at the moment, the current environment for wind energy in general. I know that the government has ambitious plans when it comes to not just renewables, but for wind specifically as well. You have a current order backlog of around 3.3 gigawatts at the moment. Can you give us an idea about what more opportunities present themselves in the current environment, keeping in mind what the government has in store, and what role can Inox Wind play here?
Hi, good morning, Agam. Good morning, Neeraj. Glad to be back. So first and foremost, maybe just a little bit on the budget. I think the recent budget maintains a very, very strong focus on RE capacity addition in India and supports Make in India with the National Clean Manufacturing Mission. I think it reduces a lot of noise around the sector over the last couple of, I would say, weeks since the US President's statements around renewable energy. Having said that, I think one thing which was always very clear, barring sentiment, was the fact that Trump's policies have zero impact on India's renewables mission and on India's wind sector, because the entire Indian wind sector is a domestic play. And India's larger renewable ambitions were all eventually moving towards a domestic manufacturing kind of an environment. And I think that's been more than evidently put forth in this budget, where they've given a huge impetus, huge clarity, line of sight to domestic manufacturing for green hydrogen equipment, electrolyzers, wind turbines, and solar cells. So I think we're very excited, very bullish, and I think it only increases our ambitions as we move forward, given that the government is absolutely gung-ho about renewable energy. I think also the recent statements from them to kind of strengthen and improve intrastate transmission infrastructure is very helpful because you've had a lot of the renewables coming up on the ISTS grid, the central grid. And I think by focusing on strengthening the state infrastructure and grid, I think you'll be able to do a lot more consumption at local consumption points or at far-flung consumption points. So that's a little bit with respect to how we see the budget and how we see the sector moving forward. Specifically on the wind side, I think the government's mission is very, very clear, very strong. I think we're looking at, in terms of various government statements, every quarter comes and goes. But I think the government really is targeting for about 10 gigawatts of wind every year from central and state tenders and hybrid FDRE tenders. Over and above that, you have the C&I market, which is very large. Now, if you're going to put all of that together, you're probably going to see almost 15 gigawatts of wind requirements every year. But I think, realistically, we would see the wind sector doing about 6 gigawatts next year. And thereafter, that's FY26. And FY27, I would expect it to be around 8 gigawatts and kind of keep moving, moving up, as we move forward. I mean, that's almost doubling of the markets in the next year, and then further, almost 40-50% increase in the next financial year. Having said that, I think also it's a very unique opportunity in India, given that you primarily have possibly two players in a duopolistic market for turnkey operations. And I think we probably are the largest players on the turnkey side. We have the largest project development pipeline in the country. And with our, recent foray into Inox Solar at the group level, I think we're probably the only player, certainly in India and probably only globally, which is offering absolutely unique, comprehensive solutions, transgressing the entire ecosystem from development, execution, to wind, to solar, to O&M services, and eventually battery as well, which is a large part of the group as we move forward.
Yeah. So Devansh, glad to hear that you were constructive on the budget. I would love to ask the next question in two parts. One is the updates, right? I'm believing you're sticking to 800 and 1200 megawatts for FY25 and 26. But I reckon in order to do 800, you need to do what, 331 megawatts in Q4, if my math is not completely wrong. On track to do that, part one. Okay, let's start with this. Are you on track to do 331 in Q4?
So Neeraj, I won't talk about specific numbers, but yes, we maintain our guidance for FY25 and we maintain our guidance for FY26. Okay. Just with respect, adding a point around that, there are a lot of questions around margin, given that we've guided for about 17%.
I'm coming to that. Devansh, okay. I'm coming to that.
Okay.
Sorry, but just one more follow-up there.
Sure.
I heard you say that it'll be 6 gigawatts in FY26, 8 gigawatts in FY27. If you do 1200...
That's what we expect.
Hypothetically, let's work with that hypothesis. And if you do 1200 out of 6, that keeps you at 20% of the market share, right? And then if the market moves to 8 gigawatts, if I presume that you are going to do only 20%, then you probably reach 1600 megawatts. I'm presuming you were not going to be satisfied with a constant market share. Is it safe to assume that you will be higher than 1600, closer to 1800 or 2 gigawatts in 27?
Neeraj, we've publicly guided for 800 this year, 1200 FY26, and 2 gigawatt plus in FY27.
Okay. So you're confident with that?
Okay. We've already said about 25% plus. And that's, if you notice over the past 3 or 4 quarters, we've virtually upgraded guidances and volume targets every quarter. This is probably the first quarter where we said, let's do something different rather than upgrading guidances every quarter. Let the market now visualize where we're headed. It's not rocket science to extrapolate what the current numbers are and what they would look like as we end FY25.
Okay. The next follow-up that I have is that I was listening to a conversation that you were having earlier, and Inox Solar, right? And Inox Solar, Inox Wind gives you the capability to bid for hybrid orders. Now, your executions as you had planned earlier, did they factor in the hybrid order wins from Inox Wind, Inox Solar combined, part one? And if not, and maybe leave that 2 gigawatt target independently, is there some ballpark estimate of what's the kind of hybrid order wins that you can do with both of these entities combined in let's say the next 2 years?
Look, let me just clarify. First and foremost, Inox Solar is in the private domain.
Agreed.
But it complements the entire larger group. So whatever statements we've made and guidances we've given out for Inox Wind are all relevant to Inox Wind until now. Inox Solar came up only about a quarter ago.
Exactly.
So What Inox Solar really does is enables Inox Wind to participate now in hybrid tenders, FDRE tenders. It also enables our EPC arm and our O&M arm, which are under Inox Wind, right? Inox Green and Inox Renewable Solutions, to further increase their profitability, business opportunities, and obviously at the end of the day, Inox Wind wins if they're going to supply more and more hybrid projects. Now, as we've stated, 1,200 megawatts next year and say 2 gigawatt thereafter for wind. On the solar side, the solar market is much larger in India. Having said that, if typically wind goes at about 6 crores a megawatt, solar, the cell modules got about 1.5 crore per megawatt. So let's not get overexcited about just megawatt numbers. In terms of revenue, we're 4 times the revenue of one cell and module. But I think we would target, as we move forward in the next 2 years, about 10% of the solar market in India very clearly. I think we have one of the strongest moats in the business. We understand the sector inside out. We have some of the largest common infrastructure assets in the country today. Our O&M capabilities are far, far more complex than solar, which I would say is fairly run of the mill. So I think we should be looking at a very, very large play on that side as well, which would only aid our EPC and O&M business in Inox Wind.
So Devansh, you don't have, I think your balance sheet is in a very comfortable position at this point in time. You can correct me if I'm wrong there, but I think it looks good at this point in time. Considering your execution targets, there will be a lot of working capital requirement. Does that mean that you will potentially need to raise funds down down 2 quarters, 3 quarters down the line? And if you would you need to consider debt or equity, or do you think that at the moment your internal accruals are enough for you to deal with whatever you have in terms of your order book?
Look, I think we've stated that fairly clearly. We're a net cash balance sheet. There is no question of raising capital at the Inox Wind level. We're throwing up significant free cash flows, and we had said that H2 would be fairly large free cash flows. We've put in our working capital, which was required to ramp up this business, and I would say that given our profitability numbers look extremely strong, we would be in a position where we would be throwing up such fairly large amounts of capital, which in fact we'll probably have to put a dividend policy in place to return back to shareholders.
Okay. And Devansh, at the moment, with respect to the pricing environment, are there any concerns at this point in time?
In terms of pricing for wind equipment?
Yes.
Look, we're virtually sold out for the next 2 years. So I don't think there's any challenge around that. Let's also not forget what's happening now is you've really got 2, 3 players in the sector, strong players, right? In terms of EPC capability, possibly just 2 players, we being the largest in the EPC segment. And with more and more focus on domestic content requirement, and I believe there will be more steps taken, this is going to just become very, very tough for some of our Chinese counterparts to even do anything. First and foremost, in terms of quality and long-term capability, I think it's chalk and cheese, number one. Number two, I think with domestic content requirement effectively coming in, and I think the budget is in fairly giving enough hints around that. I think this is only going to make our positioning stronger and stronger in the Indian market. So I think there's no question of pricing pressure. I think we're being very selective in the kind of people we want to work with. We want to work with strong, credible players who have the capability to either execute if it's equipment supply, or where we are doing turnkey for them, those who have the ability to raise capital and pay, and not just make excuses for the sake of making excuses. I think the sector's learned a lot over the past 5 to 6 years, and certainly we are using our learnings of these years to be very careful and selective with whom we work and how we work.
Yeah, a few people have survived, and those who have survived right now, Devansh, you would agree, are thriving. I still think maybe at a later date I'll try and probe this order inflow via solar and hybrid combined in a different way, because we have to wrap up this interview. But before we wrap up, I have to ask this other question, Devansh, which is that are you sensing any change in the ecosystem? It could be around tariffs, it could be around advancements in battery storage, demand, your conversations with the powers about how they envision a growth. Any change in the ecosystem currently versus what has been the case in the last 12 months?
Look, I think certainly one part which has changed is that battery costs have come down, and I think to that extent the government has become even more bullish on the larger renewable energy foray, because effectively what's been happening is, let's try and understand, if you talk of the target being 40 gigawatts or 50 gigawatts of solar a year and 10 to 15 gigawatts of wind a year, how are you going to absorb all of that? It was not possible for the grid to take in all this kind of inform power. And I think to that extent, they've now gone, there's a lot of impetus to wind. There's a lot of impetus, and you're seeing that because there are more and more hybrid and FDRE tenders. In fact, almost 90% of all tenders today are hybrid and FDRE. You've moved away in the past 12 months from plain solar and plain wind. Second, I think the government is very, very focused now on the entire domestic manufacturing ecosystem. I mean, that's something which we've been hearing. I mean, whether it's the secretary, the joint secretary, the minister, all of them have been saying we want everything, all the value addition to happen in India. We don't want imports of equipment. We don't want people dumping their goods in India. And I think you're seeing all of that happening in solar modules, now solar cells. That's also the reason why we've gone into solar. I think in wind, we were very, very clear. This is kicking in. You're increasingly going to be seeing a lot more barriers to import of equipment. They want everything being done domestically. So the domestic content requirement policy also, which is expected anytime for wind, is really going to make positioning for domestic wind turbine guys that much stronger.
Right.
We hear sometimes the Chinese and so on and so forth. Effectively, you've seen the Chinese virtually being eliminated in solar. And that's something we expect will happen in wind as well. And thirdly, I would say, I think it's only emboldened their efforts to go whole hog on net zero. So I think you saw also the nuclear target. Of course, that's probably 8 to 10 years away. It's not going to happen today. But more and more clarity around us becoming a net zero country as we move forward.
Okay, all right, fair enough. Point taken, Devansh. On that note, thanking you for joining us and giving us a lot more insight and clarity with respect to your business here. But, and of course, thanking Neeraj for joining us and making this cameo on my show. But yes, on that note, it's a wrap on this edition of KYC. Lots more lined up on the other side. Stay tuned to NDTV Profit.